The Homechoice business had its own credit book, completely independent to the Finchoice business.
Okay.
And so when a Finchoice loan was issued to a customer, she could do whatever she wanted to do with that loan, whether it was paying school fees, paying for essentials, paying for innovations. It was not used to service the retail credit.
Got it. No, the reason why it matters is because one thing I'm seeing in South Africa, and maybe you can validate or invalidate this, is that there's kind of like a movement where fintechs that were previously very niche focused are now expanding into like full scale kind of like banking capabilities, and that's having an impact on like the big four traditional banks and their role in the market and what they are providing.
We have an insurance vertical, so in the life domain, so funeral and personal accidents, we're going to be having a proper life policy, and we've also got a short-term sell captive, so we're going to add some more short-term. And we wanted to build out an ecosystem, and going sideways, so that payments was the next logical vertical to go into. So that was one of the key reasons.
What is the real measurable power of a fintech ecosystem? Today, we're finding out. We're joined by Sean Wibberley, CEO of Weaver Fintech. This is a story that starts with spinning out a lending business from a catalog retailer, using its unique behavioral data as a powerful advantage to underwrite an excluded market. The foundation evolved into a high-tech payments flywheel, supercharged by the acquisition of BNPL leader PayJustNow. The strategy is working. Sean reveals that when a customer takes a second product, the revenue value jumps by over 8 times. You learn how to leverage proprietary data, why USSD was a critical growth driver, and the strategic thinking behind using BNPL as a powerful customer acquisition engine. Let's dive in. Okay, so Sean, thank you so much for joining the show. Like, we really appreciate your time. I've been following Weaver Fintech for some time. It's a very interesting story. Your background from Homechoice all the way to be one of the most innovative fintechs in South Africa is definitely a story worth telling. And that's why I found it so important to have you on the show. So before you start, like, just give us a quick background into Sean and what you guys are up to at Weaver.
Yeah, thank you, Samora, and thank you for inviting me onto your show. So quick background on me. I'm Zimbabwean originally. I lived there for 20 years and then went to UCT. I did electrical engineering there. And then I spent the next few years working overseas in the UK and in Angola in IT. So I pivoted from being an electrical engineer into more on the tech side of things, very much focused on networking, computer networking. And I then in 1999 did my MBA back at the Graduate School of Business in Cape Town. I knew that I needed to get into the business side of tech. And following that, I did a short 3 months semester at UCLA with the vision of trying to get into Silicon Valley at that stage. But you might remember in the beginning of 2000 was the dot-com bubble burst.
Yeah.
And so everything sort of fell apart at that stage. And so I returned to South Africa and started working with Deloitte Consulting in their process and tech division, and got myself into the banking sector where I wanted to work. And after a couple of years there, after 3 or 4 years there, joined Capital One, who had an alliance with Nedbank in Johannesburg.
Got it.
And after a couple of years there was looking after their American Express Gold and Platinum portfolio. So very much learned the skills of credit, direct marketing, which was the sole way that American Express issued their cards. And I'd always wanted to return back to live in Cape Town, and an opportunity came up in 2006 to join a company called Homechoice, who had been around since 1987, and they were looking to move from being purely an online catalog telephonic retailer into being a personal lender at that stage, and hence I co-founded the Finchoice business back in 2006. And the whole purpose of that venture was to take the home choice customers, very much back then 75 to 80% of home choice customers were female. Home Choice was an innovator when it started in 1987 as the first retailer to really offer credit into the female black mass market in South Africa. It was very visionary from the founder, Rick Garrett, in order to do this. So it was an innovation in terms of selling at a distance by a catalog, as well as offering credit for the items purchased. And Home Choice became known as a trusted, high-quality brand that could understand the mass market. And so when I joined in 2006, the idea, which came from the founder's daughter, Shirley Maltz at the time was her name, she's since married, and she came up with the concept of why don't we take our female customers who are underserved in the South African market in terms of access to personal loans, and take what we do best at a distance in Home Choice and do it with the Finchoice brand part of Home Choice, and offer credit at a distance telephonically to those same customers, leveraging our expertise in direct selling, our expertise in understanding the credit behaviors of our customers, and our unique expertise in understanding the female customer, because we were very, very female biased. And we took that concept, I ran a few pilots, we worked out how to get this right, and we then really took off offering personal loans to Home Choice customers. And the value proposition is it was at a distance, you could trust the brand because we were Home Choice. It was very quick and simple. The pay line was 10 minutes on the phone to get 10,000 Rand, and customers found that revolutionary because they didn't have to go and get in a taxi and go and stand in a queue and then potentially be embarrassed or disappointed. We were able to use data to pre-approve a lot of our offers, so customers had a high reassurance of getting approval, which is very important in the psyche of customers getting credit. And we grew that business. We moved from telephonic to USSD, so online technology on feature phones, as you would well know.
And when was this? When was this USSD?
That was in 2010, 2011.
Got it.
And so it basically, I mean, for your listeners, the USSD type technology of like interactive SMS is maybe a layman's way of explaining it. And customers, again, really took to that, because it meant we went from an 8-hour-a-day call center 5 days a week to 24/7 in terms of being able to access credit. We then moved with our customer and her evolution of technology into feature-rich phones and smartphones, and we went to a Mobi app. We didn't go straight to an app because apps are expensive to download. From a data point of view, you need to have a rich phone, which back then was only really evolving. So we went to the Mobi site, and that started to swap set out with the USSD, and now we have an app. So we have some customers on USSD, it's less than 5%. Most of our customers on the Mobi site, and many of them, the highest growth area is our app. And we see customers using the Mobi site and the app, and they're morphing across and moving.
Got it.
What we also did, in 2016, we launched insurance, so standalone insurance, in the first product being a funeral plan, which in South Africa is a very popular type of insurance. So if you pass away, it enables you to pay for the funeral, which in the culture of South Africa is a very highly demanded product. So we took the same marketing skills, the platform, the customers, the way of selling, the use of data mining and personalization to start offering and cross-selling funeral. And then we launched a wallet. We called it the Finchoice Mobi Money product. And it's you pay it back in 3 months, and you have very quick access. It's exclusively available on the Mobi site or the app. So customers had to go online in order to use it, which was part of our strategy. So we helped the customers in the call center get onto the app or the Mobi site, and then access credit quite easily in the palm of her hand. So once she had signed up and done the necessary affordability calculations, taking a Mobi Money withdrawal takes less than 30 seconds.
Yeah.
And so that was a revolutionary product for us. It's about 35% now of all of our disbursements. And we grew that, and then in 2021...
Yeah, and Sean, I'll just stop you there for a bit because the 2021 part is very important.
Yeah.
But I think before we get there, let's go back to 2006, right? So that was the time you were starting Finchoice, right? And so you've got a background in Capital One. You're very technically sophisticated. And actually, 2006, if you look at it from a African perspective, doing that kind of kind of qualification was a very pioneering thing at the time, right? Now you have Home Choice, which was like a catalog-based retailer, right? And you're saying we want to lend to now this excluded black female population. What were the core data points that you had that gave you the right to do that business properly? These pieces of information, these pieces of data are useful, and we think we have an advantage over, these are the financial institutions down the road when it comes to qualifying and doing these loans properly.
Yes, so what the Home Choice business had was quite unique. They had a very well-established database of customers who were prepared to engage with that brand at a distance, meaning there's no face-to-face interaction, there are no branches, there are no stores, and they had built up the trust equity that when a phone call was made, or they would send through, the customers would send through the postal service a request to purchase some cookware, for example, that was processed, they were contacted, the delivery was made, it was made to their doorstep anywhere in South Africa, and the customer then went on a process for the next several months, depending on the term of that particular transaction, paying off the goods. And so Home Choice built up a database of people who trusted buying at a distance, a database of people for whom we had real strong behavioral credit data that no one else had because it was internal to our own business. The credit bureaus, who are very good in South Africa, by the way, they're a strong set of institutions. They have a lot of data on customers, but even back then, that data was relatively thin in the mass market. So we could augment that thin data with very, very strong behavioral data on buying behaviors with the Home Choice credit repayment, and then make credit offers to customers who the rest of the market didn't even know about. The rest of the market, even if they did have that customer come and knock at their branch or their store, might well have declined because they didn't have enough information at the bureau to reliably make a good credit decision. And so we were able to go into a market and for the first time offer customers credit that they weren't easily able to get, either logistically because of the travel or because they were getting declined, and give them credit which was then repaid very well. So our credit metrics were very strong. And after we learned that this was actually true, the thesis was true, that paying off credit meant paying off a loan would be just as good, we were then able to scale that and grow the Finchoice business. And that's really what the brainchild was of being able to sell credit to that base.
And on that, were the loans, and I think two questions come on that, which are important for the downstream conversations about Weaver. Were the loans being used to finance like home choice goods, or were they just personal loans, consumer loans, like take the loan and you can buy, maybe you need to pay your kids' school fees or something like that?
Yeah, that's a good clarifying question. So the Home Choice business had its own credit book, completely independent to the Finchoice business. And so when a Finchoice loan was issued to a customer, she could do whatever she wanted to do with that loan, whether it was paying school fees, paying for essentials, paying for innovations. It was not used to service the retail credit.
Got it. And so what I'm getting is that even the Homechoice credit book that was separate from Finchoice was a very robust data point in supporting some of these Finchoice loans. Like we also know how you repay when it comes to taking loans from Homechoice, and if you come for a personal loan, we are comfortable extending this. But on top of that, how did you collect? You give someone, you call someone on the phone, you give them, let's say, a 6-month loan, you disburse. How does the money come back?
Yeah. So in the home choice world, the products would be delivered, and the customer would literally once a month at month end, based on receiving a statement, go and pay cash at various points of payment, such as the post office, various other retailers, or they could make an EFT. So it was very much that the customer needed to get up and make the payment, which oddly enough meant that when those customers did make those payments, it really showed strong behavioral intent to pay, hence really strengthening that scorecard. On the Finchoice business side, we dispersed electronically via the EFT system into the customer's bank account, and then we collected electronically via debit order on the customer's payday. So electronic out, electronic in.
Got it. I think that now clarifies everything. And so, and now we're coming into 2021, and by this point, FinChoice is a sizable, at least growing well, lending business, lending into a market that has traditionally been underserved, and that has got good repayment dynamics. And it's something you see across the continent, where in some instances you see like females are more likely to repay their loans. In a number of studies have shown that. And so you're growing well. You've also added now fintech capabilities in terms of payments, right? And the Mobi, the wallet. And so it's now looking like a comprehensive fintech, right? But in
Yeah.
2021, you decided to acquire PayJustNow, right?
Yes.
And the question here is, why was that necessary? Why didn't you now just build out BNPL capabilities within Finchoice? Because you've got the customer base, you've got the data, you've got the underlying infrastructure to go at it on your own.
Yeah, so there are probably two answers to that at least. The first one is that we had a very well established lending vertical, which had now been augmented with the Mobi Money wallet product, so it was a very vibrant vertical. We have an insurance vertical, so in the life domain, so funeral and personal accidents, we're going to be having a proper life policy, and we've also got a short-term sell captive, so we're going to add some more short-term. And we wanted to build out an ecosystem, and going sideways, so that payments was the next logical vertical to go into. So that was one of the key reasons. The other reason is because of the rapid growth of the Finchoice business, relying solely on the home choice customer as a source of names to mine in order to cross-sell credit was limiting our growth. So we then started testing in the sort of the back end of the 20 teen years, into acquiring customers externally. Very much like the competition are required to do. So obviously the bad debt on those customers, the credit behavior was a little bit more volatile. So we went in there slowly, learning our credit skills, enhancing them to be able to book external customers. That grew to a certain level, and we thought what we need is another business in the group that can supply names and sources of acquisition for the lending business and the insurance business. And the payments business was therefore the no-brainer, because buy now, pay later is a phenomenon where it's very viral, great word of mouth, and they attract a lot of customers into that product set, which then enter the ecosystem, and then we can look at the best performing customers within that and do the same with home choice with PayJustNow. In other words, cross-sell lending and insurance.
Got it. So it is fundamentally a customer acquisition channel, of course. And by this time, home choice is also, there's kind of like structural barriers to growth, right? Like, the growth of e-commerce, changing consumer tastes, and therefore maybe also home choice is not growing at a scale, at this kind of scale, and you have to now diversify your sources of customer acquisition. And so you buy PayJustNow to augment that, to give you another level of growth uh, for your
Yes.
underlying like high value fintech businesses.
Absolutely. So
Yeah,
right now, over 90% of acquisition into Weaver Fintech comes into the BNPL product.
yeah,
And we still are acquiring lending and insurance customers from the external market and from Home Choice.
mm,
But a key growth vector for us is the cross-selling of those two higher margin verticals into the BNPL vertical. So BNPL, as you know, has quite low margins,
mm,
um, but it's very attractive to customers. It's very attractive to merchants,
yeah,
and so it's a very symbiotic product. It really does grow, and we are dominant now in the South African market with the product. We're booking 120,000 a month now. Last year we were booking 100,000 a month, so the rate of growth itself is also still increasing.
yeah. And is that
We have
110,000 new customers or transactions? Just clarify that.
yeah, so no, it's 120,000 sign-ups onto the platform.
Got it. Got it.
Of that, some customers don't later on qualify for credit because
Mm,
the buy now pay later product is extremely risk tolerant, being very short term.
mm,
So for me, I can't think of a more financially inclusive product
mm,
than BNPL. I mean, obviously having a bank account is an entry to the game, and in
yeah,
South Africa, anyone who wants a bank account can access one,
yeah.
and potentially for free as well. So
Mm,
it's that is the hero product. But BNPL, why I say it's such an inclusive product is because customers with thin credit records, we are able to, using our behavioral models, work out whether this customer is going to be good for the amount of limit we give them,
yeah,
and that we can low and grow customers and build up their credit profile. And there's no credit and no fees, so customers can learn how to essentially split a payment at the till and pay over time. And
mm,
that behavior is a great intro for younger customers and less credit aware customers to learn to respect payments in the future. And that behavior we can then take into our lending, which obviously is over a longer period of time and is larger amounts and needs more behavior in order for our models to cement the offerings.
yeah. And for this BNPL, I think there are two questions that come out of this. Again, there's one just mechanical, like so, maybe walk us through how the core product works, at the POS. I know you scan a QR code, it's all automated. So how do you now capture the payments on the customer side? Is it the same direct debit orders that you traditionally did with Finchoice? So that's the first part. The second part is more like I wouldn't call it philosophical, but why does BNPL work so well in South Africa? Is it the advanced retail that I think 60% formal retail penetration vis-a-vis some African markets where it's like less than 20%? In your view, what's the thing that makes BNPL work so well in South Africa?
Okay. Well, so your first question around how the transaction is captured
Mm,
at the point of sale and how the BNPL payments are then collected later on.
mm,
So the product is a pay in three. The customer pays a third up front and then a third on their first payday after that, and the third in the following payday.
yeah.
South Africans are paid monthly typically,
Mm,
unlike a lot of overseas models where people are paid every 2 weeks, and that's where they have them every 2 weeks.
yeah.
So it's the average tenure is about 43 days, 42 days. The transactions, 60% are in store, 40% online. In
Mm,
store, the customer gets their PayJustNow app, scans a QR code at the point of sale, and makes the purchase.
mm,
PayJustNow then debits them in real time the one third,
mhm.
and then tokenizes the next one third for a month later and the next one third for a month after that. So it's
Got it.
collected using the card rails, either debit card or credit card.
Mm, mm,
And online, obviously, it's a checkout using PayJustNow as the preferred payment
yeah.
method.
Yeah.
And so, yeah, why is PayJustNow done as well as it has in South Africa?
Mm,
So you're right that a lot of formal retail malls and stores and so on are integrated with Visa, MasterCard, and customers are used to engaging with those platforms. And as I said, it's such an inclusive product. I think some customers who would have paid cash for a product, literal rands and cents, or use their debit card and paid 100% upfront, or some of them a credit card, are now going, well, hold on, let's rather go use buy now, pay later, because it's a no-brainer to split my payment 3 ways. I believe we're getting more customers who would have paid cash now choosing to pay on buy now, pay later, because they're getting the advantage of the split in 3. And merchants are also driving this, because the merchants get higher conversion through their online checkout. They get customers buying up. So if you wanted to buy a pair of sneakers for 3,000 Rand, but you could only really afford 2,000 Rand, you can now buy the 3,000 Rand sneakers because you're paying 1,000, 1,000, 1,000. And customers are appreciating that affordability, and so they're buying what they're able to buy and want to buy, and which is made more affordable at no cost. And so the merchants are seeing higher conversion, higher sales, and they're also seeing it literally in the numbers. So every month they're able to see the type of sales a buy now, pay later PayJustNow customer has versus a typical customer, and they can see that differential.
Got it. And so, in terms of like annual TPV, what is that looking like for PayJustNow at the moment?
So annual GMV?
Like GMV, GMV.
Yeah. So I don't want to lie to you, so I'm just going to look at my stats here. Okay. I mean, we're probably going to end the year on 7 or more billion Rand of GMV.
Okay.
That's up about 100%.
Wow.
On our last year. So the rate of growth is high. So what we're seeing is we are adopting more and more merchants. So there's a greater footprint for customers to shop. We are adopting more and more tier 1 merchants. So the big merchants that get a lot of natural demand from customers. And of course, we're booking 120,000 customers a month into the ecosystem. And so you're just getting that flywheel effect happening. And what's also, I guess, most telling is that existing customers who we booked last year, the year before that, and so on, are buying more on an annual basis in this year and more frequently. So because the product is paid very quickly in 42 days, for the same credit limit, that customer can buy several times in the year. Got it. And turn the same credit limit many times. And so naturally customers are buying more frequently. It's a swap set of what they were doing before, and it's more convenient and obviously more affordable.
Yeah. No, that makes a lot of sense. And of course, one of the questions maybe that a cynic would ask is that, like there's been anemic economic growth in South Africa for the last 5-10 years, maybe even longer. A lot of surveys are showing increased customer indebtedness, or people relying more on loans to go day by day, like to just stretch their income. When you look at that, when you look at your growth, and when you look at what's happening in the economy, are you how much do you attribute to like this is just the viral growth of BNPL because it's an amazing product, or South Africans are struggling and they need loans to make day by day purchases? And if it's the latter, like, aren't you worried that at some point the entire thing just crumbles?
No, there's no question that the South African consumer has been under strain for a while.
Yeah.
And the affordability rates, official ones, are sort of 32-34%.
Yeah.
But it's been like that for a while. And customers are using credit, paid for credit, in order to on essentials, not necessarily on non-essential or durable type transactions.
Yeah.
But the buy now pay later product does allow the strained consumer to make things more affordable at the till without getting into a spiral where they're paying for credit. So I think your question more related to if the South African economy suddenly became buoyant again and customers were flush and feeling, they had money and they weren't under strain, would they then suddenly stop using buy now, pay later?
Yeah.
And I strongly say no to that, because if you look around the world, buy now, pay later, which has been a phenomenon in all of the first world countries that it's been in, customers are using it because it just makes sense to split your payment 3 or 4 ways at the till.
Yeah.
If anything, a smart consumer knows that the cost of capital is serving you rather than the other way around,
Yeah.
because the customer isn't paying anything. And online, it's another feature that people don't spend a lot of time on, is buy now, pay later online. If you've engaged with PayJustNow, you've uploaded your debit card details, and you've got a limit for 3,000 Rand, for example. If you go shopping at an online retailer that you've never heard of before, but you like their product, if you see, when it comes to checking out, you've now got to put your credit card details or your debit card details into a website that you've never used before, and some customers walk away then.
Yep.
But if you can see that PayJustNow is a checkout method, you click on PayJustNow, the retailer doesn't know anything about your credit card details or debit card details. They just know that PayJustNow is settling them. So it helps consumers make payments and transactions at websites they're unfamiliar with.
Yeah.
It's another, for me, an unsung boon of BNPL.
Yeah.
And it's convenient, it splits the payment, it allows you to make transactions at websites you're not familiar with. And globally, it's a phenomenon where year on year customers are increasing their frequency and their use of the product. And I don't believe it's because the world is under massive financial strain in every country.
Yeah. No, very valid points. And I think I like the insight around, BNPL as a trust anchor. When you see your BNPL there, you feel more confident to make the purchase. I think that's an angle that's not told as often as it should be. But now switching to another thing is, the fintech industry in South Africa has been growing, right? Like, I think recently Nedbank acquired Ikoha. Like, there's real momentum in South Africa around the fintech industry, and guys like yourselves are just adding to it. But despite all that, I think cash is still very important in South Africa. Countless of Reserve Bank reports keep showing how, at the end of the day, people are still withdrawing all their money at the end of the month, and converting it to cash and using cash, right? As Weaver, do you have any perspective about that? Specifically, does it matter for your business if cash utilization remains the same, or does it help if digitization of financial services increase, like people now adopt digital payments more and more? Like, what does that mean for a BNPL business like yourself?
Yeah. So, firstly, I share your sentiment and the research that a lot of customers or consumers, put it that way, in South Africa get their salary and then draw it all out that morning and then spend it as cash. And it would seem counterintuitive because of crime, and carrying cash around on payday is obviously a dangerous thing to do.
Yeah.
And there's a massive informal economy, so a lot of the transactions that happen there afterwards are hidden because it's in cash. And that's a very vibrant part of the South African economy. So, how does one digitize that and streamline it and make it safer? And that's one of the big elements that we focus on in the Finchoice business, is because our customers, our heritage customers, predominantly female, underserved from traditionally in the past, what more can we do in that space? And taking cash out of her hands and giving you an instrument that is convenient, that she trusts in order to make transactions without cash, I think is powerful. And BNPL is, for me, one of those products where it's better to use BNPL than to pay in cash because you can split the payment.
Yeah.
So that would encourage some usage there. And I also believe that customers have a fear that when money goes into their bank account, it gets taken out by the bank. And I don't mean by the bank, but all the debit orders that might come and arrive in it. There's a bit of financial misunderstanding there. So customers have low trust, and hence they take their money out. One of the things we want to do is give customers a line of credit that we've ascertained that they can afford, and we believe behavioral they'll be able to look after and manage, and link that to a card so that she can then go and use that debit card in the marketplace. And it's not her bank account, it's a ring-fenced wallet linked to the card that allows her to access or make digital transactions rather than cash transactions.
That makes a lot of sense. One of the questions that come, and you mentioned about the debit orders, the utilization of cash. One of the things that emerges is that I think globally, and South Africa is not an exclusion, you're seeing more and more of young people going into kind of entrepreneurship, gig work, and less of the traditional employment, right? I think it's a trend everywhere. Even statistics from essays show like SME formation, or at least micro SME formation, is increasing, and that may have an impact on your business, because traditionally you've been kind of taking debit orders based on salary, right? Especially your Finchoice business. um do you have any opinions about that, especially how like Finchoice remains relevant to a micro entrepreneur as opposed to a unemployed individual, not unemployed?
So yeah, so just to paraphrase back to you to understand, so the gig economy freelancers, they don't get paid on the last day of the month like many other salaried employees. They get paid as the money comes in and so on,
Yeah.
making it more tricky to collect an installment on the last day of the month, because the money might not be in the account then because of the way the cash
They
flows
have
work.
irregular cash flows.
Yeah, so our business model has traditionally been in the Finchoice business to take salaried employees only and to strike their bank account on the payday. What we have done though is in the home choice world, where the customers often are paying with actual cash when they're able to at the beginning of the month and not on a specific day, those customers that are marked in our system as being freelancers or self-employed, for example, who have proven that they can manage their cash flows and honor their payments, even though it might not be on a specific day, we are able to take that data and offer those freelancers credit. So that said, it's about less than 4 or 5% of our book.
Got it.
But it is something that we acknowledge we need to get into, because the gig economy is growing, and a line of credit from a customer who can then make a push payment to us is something we would explore. At the moment, that's not our model, and we're still growing. So when there's growth, other growth to look at, we'll explore that.
No, makes sense. And now going back into the flywheel, and it's something that's very interesting. You have an ecosystem of 12-month loans, 6-month loans, insurance, payments. What is the ideal end state? Like from your perspective. So you've got like a very low margin BNPL customer coming through the door. What is like an ideal end state in terms of like revenue per annum, a number of transactions, or size of loan that really is the sweet spot for like that conversion cycle?
Yeah, so I mean, as you say, the customers come in on BNPL over 90%, and the ecosystem goal is to watch those customers, filter the best ones through, and offer them credit and insurance products. Obviously, insurance products don't have a credit bias, but on the lending side, it does. And so, our end state, what we do currently, is have cross-sell options in the digital ecosystem, use data to personalize and pre-approve offers, and showcase these to customers to get them to take that second and third product. At the moment, we're about 20% of our ecosystem, our active ecosystem customers have 2 products. And our goal, our end state, we think is a sweet spot, will be 50%. Now, what's a counterforce to getting to that 50% is the extremely high growth in people with 1 product, because they're taking the BNPL product and the denominator is getting very big there. So as that growth slows a bit, and as we get better at the ecosystem cross-sell, we we intend to get to 50% of customers with 2 products or more. And why this is so relevant is that what we see is a customer who has on average 1 product has an average revenue over a 12-month period of just under 1,000 rand. But when they take the other products which are higher margin, that jumps dramatically to over 8,000 with 2 products, and about 10,000 with 3, and then it really jumps materially. And because the customer has engaged with us within our own ecosystem, our cost of acquisition and origination is very low.
Yep.
So that's the sweet spot with the ecosystem, is to get the flywheel of the cross-sell enabled.
And how are you thinking about like layering on additional products? Like, what is in your view? I'm sure you've had a lot of strategy discussions, internal meetings about it. You're definitely thinking about adding additional things, and there's some sort of matrix in terms of like how well it fits into the existing product, how complex it is to actually layer it on, but most importantly, like what's the probability of it really adding revenue to the business? What are some of the options you're looking at in terms of like potentially it's a savings account, potentially it's a wealth account. What are some of the things you guys are thinking about?
Yeah, so we've got the 3 verticals: payments, lending, insurance, and we want to expand the breadth of the insurance offering. So staying within insurance, but adding short-term cover and
Yeah.
looking at other types of policies that would befit our base and our ecosystem. So, for example, you make a purchase using buy now, pay later, and we notice that it's a fridge, and we offer you in the sales flow whether you would like short-term insurance on the fridge for extended warranty, for example, or a maintenance contract. So we're going to be looking at those kinds of things to deepen the depth of the verticals, and then going sideways. Yeah, do we have a bank account? Do we add in other neobank type attributes to broaden our offering, money transfers,
Yeah.
and the like? And those are very much on our roadmap, and we're currently exploring them. But I don't want to speak to what our future strategies are just yet, because they're still nascent.
Got it. No, the reason why it matters is because one thing I'm seeing in South Africa, and maybe you can validate or invalidate this, is that there's kind of like a movement where fintechs that were previously very niche focused are now expanding into like full scale kind of like banking capabilities, and that's having an impact on like the big 4 traditional banks and their role in the market and what they are providing, just based on
Yes.
like a mismatch in terms of how financial services should be distributed in South Africa.
Yes. So, I mean, Capitex now makes up the big 5, and they've done a fantastic job
Yeah.
using technology
Yeah.
and simple products and diversifying their product set in terms of taking market share. It's been a tremendous South African success story. And in our world, yes, as a fintech, we were a monoline fintech looking at lending only, and are diversifying our range, because we believe that customers are attracted to one or more of the products within your stable.
Yeah.
And then if you've got because it's integrated technically and also integrated in a single customer experience on her smartphone, you have the ability to cross-sell and meaningfully use data and AI to serve up the right next best offer.
Yeah.
And so you can really take market share and get great acquisition and cross-sell happening in a nice flywheel effect.
Yeah, and now sticking to going back to BNPL, and this is something that always confounds me. Not really confounds me, but I think about it a lot. Um, Everyone now is trying to do BNPL, right? But it seems like only a few players really do it well, right? So
Yeah.
banks are coming up with the BNPL offerings, whether that's South Africa, Nigeria, Kenya, everywhere, even in the US and Europe. People, banks come up with BNPL offerings. Non-BNPL players also try and enter into the space. But it seems like, the main BNPL players, whether it's Affirm in the States, it's Zip in Australia, and all these kind of players, they keep and retain and grow their market share despite all these people nibbling at their market. And it seems like, from the outside looking in, there's a specific or maybe a mix of specific capabilities that you have to get really right. And some of these new entrants don't understand. And maybe my intuition is that it's potentially around merchant acquisition and just onboarding merchants. It's something around the POS environment, just how seamless that is. In your view, what is it that you really have to get right? Not even in your view, in your experience, to really
Yeah.
scale a BNPL product.
So because BNPL, let's talk about the South African context,
Yeah.
was a disruptive technology.
Mm.
It came into the market. The team that started it were very, very niche and focused. So you're working with a number of merchants, and to get traction, it came in sort of without BNPL being well understood, and was really excellently executed from a tech point of view, from a focus on what the merchant's needs were, from an integration at the POS, using simplified API technology that linked to common shopping platforms like Shopify, WooCommerce, and so on. So the plugins were very simple for basic merchants who don't have a
Yeah.
tech team, for example, to understand
Yeah.
and to do at scale. And the and it's almost because the PayJustNow were not a bank; they were a payments disruptor offering a solution that merchants really valued, because they could see that when they trialed it, they could see that customers bought up and they could see the conversion was better, and so that it became a no-brainer that they were paying a higher commission for BNPL than they were for a card, for example, but it was well worth it because
Yeah.
it's a win-win-win between the merchant, the consumer, and PayJustNow. So why? Your other question: why do banks not do this, or when they do they seem not to do it as well? For example, as the niche players, and I think it's probably to do with focus, an intense focus on the customer. You'll remember we bought PayJustNow. It was about a year old and had I forget the number, but not a lot of merchants, not a lot of customers. I think they had 40,000 customers and several dozen merchants.
Yep.
HomeChoice and Finchoice are retailers by heritage, very focused on the consumer, what the consumer wants, what the consumer needs. And I think banks miss that a bit because they're massive and they've got big balance sheets to contend with and
Yeah.
existing portfolios to manage. And an innovation, a disruption is a distraction. It's very hard to get in there and focus on it to the exclusion of all else.
Yeah.
Which is what PayJustNow have done, and what we were able to then do to take it from a startup to a scale up within the Weaver portfolio.
Got it. No, you're right. I mean, it's a lot of this, and this, it applies across fintechs. Whether you look at payment companies like Paystack and Flutterwave in Nigeria or Stitch in South Africa, there's a lot of value in focusing on a specific problem very well and going very deep. Which, if you're a multi-revenue bank with so many things to worry about, it's just organizationally very difficult to accomplish that kind of focus, and it makes sense. Now, looking forward, like, what are the things that are really exciting you about Weaver? I mean, and congratulations on now transitioning from HomeTrace to Weaver. Now Weaver is the listed entity in the JSE. Your revenues have been growing, and just as you mentioned, 100% GMV growth for this year. It's been a really impressive story. So what are you looking forward to the most in the coming years?
Yeah, well, for me, there's a couple of things. So we've got an innovation product in our payment space. So we've got the buy now pay later product that's split in three, which the customer doesn't pay any interest or fees for. But some customers want to be able to afford even larger items and hence pay credit over a longer period of time. So we've branded that Pay Stretch, and customers can pay in 12. We're launching soon a Pay in 6, and then a Pay in 24, and so on. All done in real time at the checkout, online and in store. And so that for me is a natural growth vector for the payment space,
Yeah.
because we have an incumbent network of merchants and customers who are already signed up with PayJustNow for BNPL, and the addition of another payment stream is a simple flick of a switch,
Yeah.
quite literally, for customers for merchants to enable it, for customers to then use it. And so that for me is going to be a really exciting ride for us. And the other element is more general around our ecosystem. We've lending, insurance, and payments. We are more and more blending the UX, getting customers to see all three product verticals in tandem with each other, and to drive that flywheel effect with better use of AI with our data to showcase the best products to customers. So making the user experience of taking our products really sing and getting that 20% to 50%. Because that for me would be a fantastic success for Weaver.
And you don't have to be very specific. Like from a Weaver revenue perspective, let's say you're on X or like 100. When you move from 20 to 50, what's going to be the impact on revenue? Is it like it doubles the revenue, or it changes the margin profile? What like if you're looking at Weaver's business, that change from 20% kind of cross sell to 50% cross sell,
Yeah.
where's the impact going to be?
What happens when you move from 20 to 50 is the cost of acquisition plummets because you're not paying outside for a name. It's digital by definition, so you're not using a call center or any manual process in order to get the sale done. That's already happening anyway, but it just means that every additional sale you make is a free name and a very low digital origination cost. You get enhanced retention, so customers are more sticky in your ecosystem because they've got 2 or 3 products that they like, and so they honor your ecosystem more than, for example, another provider. So you get better payment rates, which means your bad debt comes down a bit. As a result, you get more data points in terms of the interaction across the products and the ecosystem or the UX, so that you can then use to inform your behavioral models. So you can make better decisions about creditworthiness, and you can make better decisions around the next best product to offer customers in the UX. So the whole thing becomes very virtuous and builds up a flywheel effect. So for the jaws open between revenue and costs, and you increase your margins, which means that you can take on lower margin products or have discounted priced products, which makes you even more attractive. So at the expense of margin, which you've now made up by cost savings, you can give that back to the consumer, and you can then really get the whole machine, the whole platform really humming. Our goal is within Weaver on the ecosystem is to sort of be a world-class sort of platform for everything to do with her money, so that enabling her, our female customer in the main, and our merchant partners and businesses to really thrive with simple and fast financial solutions. So that happens because you've got a real focus on who the customer is and who the merchants are and what their needs are and how you can meet them on your system. And if you keep your costs low, which happens with digital, and by having low cost of acquisition, it really allows you to innovate.
No, a lot of interesting things to look forward to, and it's an extremely attractive business. And one thing I do admire about the South African commercial ecosystem is this ability to kind of like renew yourself. I think we've seen it with Home Choice. I think Pep is doing some interesting stuff on the fintech side, and recently also Moment. MultiChoice has a payments business called Moment that has really been growing. And so I really admire that ability of the South African corporate ecosystem and the ability to renew, reinvent themselves, and innovate. I think it's a story that's not told as often as it should be. I always say all these stories make very interesting Harvard MBA kind of case studies. Now, lastly, like, who do you benchmark yourself against? As Sean, when you're looking across the global, it doesn't have to be a fintech, but just the global commercial system. Who do you benchmark yourself?
So, I look a lot at Capitec. I think they are a superb business in the South African context, and they do a lot of what we do. So they're in the lending space, the insurance space, the value-added services space, and they're building an ecosystem. Albeit they have lots of branches, it's still very tech-driven, and they really have a good. Of all the banks, I think they have an exceptional focus on their consumer, as we do. So I admire them, and I definitely benchmark our performance against theirs. Globally, Klarna and Affirm are big BNPL providers that are diversifying into longer payments and shopping experiences for customers, again, very similar to what we're doing.
Yeah.
So we look a lot at them. Ant Financial, the Ant Group, I think they've renamed, probably the best definition of a super app in the world, really.
Yeah.
I think they've got over 1 billion customers, and they've got thousands and thousands of merchants and consumers in this ecosystem where everything to do with transactions and money is being curated by them. They do fantastic work. And all of them that I've mentioned are businesses that are scaling. So they're growing, even Capitec, which is massive, is growing at 20%, which is outstanding. Other ones I look at, Nubank and Revolut. I like their user interface, their diversified portfolio of offerings to consumers, and also they've been extremely disruptive.
Yeah, for sure.
And they've entered the market from a different point than we have, but they're diversifying their product set, and so is Weaver, and we're coming at things in a different way. So it's interesting to see how that plays out.
Yeah, Sean, thank you so much. This was incredible. I think so many useful insights. I think I learned a lot from this discussion, and congratulations again. Thanks for coming on the show. Thanks for sharing your insights with us. And on my side, I can't wait to see how Weaver grows in the coming years and some of the things you do. I'll be following very keenly.
Thank you, Samora. Thanks for your time and the invitation to your podcast. I really appreciate it.
No problem.